Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, any hopes for progress on a trade deal with China dashed. Beijing saying overnight the talks between the two countries haven't even started. And officials calling on the U.S. to revoke all unilateral tariffs. That defiant tone contrasting with signals of de-escalation from both President Trump and Treasury Secretary Scott Bessent.
And that news weighing on futures this morning. We are seeing some mixed activity after the major averages notched 2 straight days of gains. The first back-to-back gains of over 1% since Election Day. But we're off earlier lows, and durable goods orders in March surged more than 9%, the highest level since July 2024. And the threat of tariffs likely driving orders ahead of the April 2nd deadline.
And a busy morning for earnings dominated by one word, tariffs. American Airlines joining a growing list of companies withdrawing guidance over trade policy uncertainty, plus Procter & Gamble and PepsiCo among the names slashing their guidance.
Well, earnings season is in full swing with dozens of major companies, household names reporting results this week. Investors keeping a close eye on whether tariffs and related uncertainty weigh on companies' outlook for the rest of the year, especially for consumer stocks. Yahoo Finance's executive editor Brian Sozzi has more insights here. And this was the sense that we got early on in the earnings season, that uncertainty would be kind of the mode or the theme.
Yeah, if there's any positivity off the jump, let me just, I'll start here, is that these stocks aren't falling off a cliff pre-market. It's PepsiCo, P&G, I look at Coca-Cola, how it's trading after those PepsiCo guidance cuts, not really falling off a cliff, so that's good, but that doesn't mean the numbers are good at all. PepsiCo, for a company that I've covered probably 15 years, they take guidance super seriously, some would argue perhaps too seriously. To see them come out here this morning and cut guidance, essentially seeing no earnings growth this year. 3 months ago, they were looking for low single-digit sales growth, and it's really a two-pronged thing here, not only with PepsiCo, many of these consumer companies. The tariff, the cost hit from tariffs, but also demand has started to weaken. Demand's starting to fall off in March. It looks like a lot of those trends have gotten worse into April. But then I talked to P&G CEO John Moeller. You can read a little bit more on that conversation now on our homepage. But I asked Moeller, are you seeing consumers trade down? He told me no, but he is seeing consumer pressure. Here's what he told us.
And what you see is a reduction in the number of loads that are done per week currently, going from about, if you go all the way back pre-COVID, to about 5 loads per week to now about 3.5. So that's what's driving the slower market growth, still growing, but at a slower rate.
And why I asked John this, guys, is because out of all the company's business segments, they did okay, but the fabric care business, of course, that is Tide detergent, that division didn't grow. So to John's point, consumers are under pressure. Good for P&G, they're not trading down just yet. But again, they are perhaps putting a little water in that Tide detergent at the end of the week to make it last a bit longer, doing a little bit less laundry. To me, all that is a red flag. I know the stocks are down, but to hear P&G, probably the world's most iconic consumer packaged good company, telling investors that people doing less laundry a week, that's a red flag. You got to clean your clothes. I mean, I'm not wearing dirty clothes to work.
But that's also what's so important. You never are, Sozzi, of course. But what's so important about that there, just to really put a bow on this for the audience, is that that's a consumer staple. You're pointing to it. That's a need for consumers. That's not necessarily a want, which maybe the extra guac on your Chipotle bowl is considered a want. What is the broader story that you're getting in terms of what all of this tells us about where the consumer is at right now?
Consumers straight up just under pressure, guys. They are pulling back. I think they're now starting to realize that the price increases from tariffs are starting to hit. Maybe that, I think for some companies, we're waiting to the back half of the year to push that through. They're now pulling them forward. I look at the conversation that our very own Brooke DePalma had with Chipotle's CEO last night after earnings. I encourage everyone to watch this interview. Brooke's first question off the jump asked about the state of the economy. Here, Chipotle's CEO described the pressure on that consumer, which has historically done very well during periods of economic stress. to see him talk about stressed consumers report their first decline in same-store sales since the pandemic, again, another red flag. I know the market may be taking it in stride this morning, but to me, as someone that's crunching the numbers, not good for these companies and also for a lot of their competitors that have yet to report yet.
You know, keeping kind of with the CEO theme here too, many of the retail CEOs have been trying to get the ear of the president, and in recent days they have. They've been able to kind of make their pilgrimage to Capitol Hill, try to make sure that they've got time at 1600 Pennsylvania Avenue in order to let the president know what exactly they're forecasting or how hard the self-induced nature of some of the tariff announcements have hit and impact some of their forecasts and make it more uncertain going into the next or beyond the next 90 days here, which spells out a more larger kind of economic scenario that could spell turbulence ahead.
Yeah, and after that meeting early in the week, reports were that retail executives, I believe it was Walmart and Target, warned of potential empty shelves. I asked Mueller about that too. From his perspective, he's not seeing, from a P&G perspective, not likely to see empty shelves from their products, but doesn't mean we'll see it from other companies. A lot of these big consumer packaged good companies, because of the hit to tariffs and where they get ingredients from and packaging, they're going to have to cut back on certain stock keeping units or certain products just to more efficiently keep their operations running. That might mean you go down to Walmart and your favorite product's just not there. That's the reality, and that's not a reality a month from now. That's probably coming right at consumers probably in a few weeks.
And a headline crossing right now, too, container bookings to the U.S. from China are down by 1/3. So that's concern from retailers about stuff not being on the shelves. Very critical. That's coming from a German shipping company this morning. Sazi, thank you so much.
And I do clean my clothes.
Yes, of course you do. Of course. We all do. I don't have a laundry machine.
Appreciate you.
But
Do you
I
use the
outsource.
fabric softener too?
outsource.
I use everything.
All right, Sazi, thank you so much. Stay tuned all morning long on Yahoo Finance. We're bringing you C-suite commentary from Raymond James, Southwest, Whirlpool, and ServiceNow. All those conversations to come. Well, tariff uncertainty took a toll on Raymond James in the fiscal second quarter. The bank's revenue falling short of analyst expectations, dragged down by a month-over-month decline in the business's capital markets unit as tariff uncertainty weighed on investment banking activity. Joining us now to discuss the quarter in an exclusive interview, Paul Shoukry. He's the CEO of Raymond James, speaking with us for the first time since taking the helm. Paul, it's great to speak with you. Appreciate you making the time for Yahoo Finance. I want to start on your outlook for this economy. What inning would you say we're in terms of the economic turmoil right now? How would you characterize consumers based on activity that you are seeing?
Great to be here, Madison. I would say, as far as the economy goes, a lot of the fundamentals of the economy are strong. Unemployment is still relatively low, and the job market is strong. But there has been near-term a lot of uncertainty around the trade and tariff negotiations. And I think the answer to how this impacts the economy is really going to be answered by how quickly these tariff negotiations and the uncertainty around those negotiations get settled out. It sounds like the Trump administration is looking to de-escalate, I think, which would be welcomed by the economy and by the markets as well.
It seems like some of that uncertainty, Paul, and thanks for joining us this morning. It seems like that uncertainty has impacted near-term deal-making, which was what CEOs were so excited about. It seemed like coming off of the election that it would be a more favorable environment for deal making. That's not the case right now because they're just trying to focus in on running their businesses. I wonder how you're kind of continuing to converse with some of and getting kind of the pulse of those same CEOs who are trying to figure out both running their business in this environment, but also making sure that they're kind of keeping a few of the irons in the kiln, however you want to kind of think about keeping it on the burner for some of those conversations.
You're exactly right, Brad. Just a couple of months ago, the pipelines and the outlook for investment banking across the industry was very strong. And really, the pipelines continue to build. I mean, just last week, I spoke to a CEO who was looking to transact, and we actually signed up an engagement with that company. And they're waiting on the sidelines. There's a lot of pent-up demand after 2 years of very little M&A activity across the industry after rates started rising following COVID. and there's motivated buyers and sellers, particularly financial sponsors who have portfolio companies that are well past their initial hold periods, or buyers who have capital that they need to deploy. So I think, again, once there's more certainty, there's a lot of potential. Our pipelines at Raymond James Investment Bank are very strong, but we do need more certainty for those deals to get done, because in this environment, it's very hard for whether it's a CEO of a strategic buyer or seller or a financial sponsor to make big bets when day to day the markets are going up or down 1,000 points and tariffs are changing dramatically day to day. It's just hard to make big bets given the level of uncertainty that they're dealing with.
And I hear you saying the pipeline's robust, but you got to have those closings at a certain point, Paul. To what extent are you concerned that these tariffs and the negotiations are a story that is going to continue perhaps for the rest of this year or potentially even longer, given that we have China this morning throwing cold water on the idea of any negotiations?
Yeah, I mean, that is the key question, Madison, is when do we get more certainty around these tariffs? I mean, I can't tell you, no one can tell you in the next week whether or not within 100 percentage points where the tariffs with China will be, for example. I mean, that's a pretty dramatic range and has pretty significant impacts to the markets and the economy and the ability to make decisions as a CEO or a financial sponsor client. Mm-hmm. So I think it's just a matter of how quickly we can de-escalate these tariff negotiations and get more certainty.
And I also want to talk about corporate loan demand. That was weak for the quarter, and that came before Liberation Day impacts, of course. How worried are you that the uncertainty bringing that trickle down in on corporate loan demand could lead to a grinding halt in quarters to come?
Yeah, corporate loans are a relatively small part of our portfolio, but a lot of that is associated with M&A activity. So I think my comments would be consistent there. What we have seen grow is securities-based loans to our private client group clients. And I think clients have gotten used to the new level of short-term rates, which drive those borrowing costs. And after 2 years of really paying down those borrowings, they're re-engaging in borrowing. And so we have seen healthy loan growth in securities-based loans.
Yeah, I do want to put some more numbers on that, too. As we're thinking about the client assets under administration in this most recent report, $1.54 trillion to be exact. Don't want to shave any of that success off of the business, of course. And then the private client group assets and fee-based accounts, $872.8 billion. Those are up 6% and 9% respectively over March of last year. I wonder, though, in this environment, because it is different from March of last year, how you're seeing some of the wealthier clients that you manage assets for navigate, move assets around in this environment to try and kind of mitigate some of their exposure to current market volatility?
Yeah, I mean, just last week I was with an advisor and their client who had several $100 million of investable assets. And to your point, Brad, there's a lot of uncertainty that the client was expressing in the meeting. But the financial advisor, and this is we're a financial planning-oriented firm, and the financial advisor told the client, we're not trying to time the markets day to day or week to week or even month to month. We have a long-term financial plan that's set for the next 5 and 10 years and beyond, and that plan is working. And there's a lot of rebalancing, actually, in this type of market environment to keep the plan aligned with the objectives of the client. And the clients have liquidity to sort of weather the storm near term or the uncertainty near term. And so, as a financial planning-oriented firm, it's these type of environments which really highlight the value of having a financial advisor to help you navigate this period of uncertainty.
Paul, many of us are old enough to remember that before all of this market volatility, we probably would have been asking you about how artificial intelligence and Gen AI might be playing a role in the future of Raymond James, especially when you think about that advisor relationship. Is that something that's being prioritized at all? How do you kind of work across some of the new technology to make sure that you are advising clients in a capacity that continues to make sure that their wealth is secure at a time when, they're otherwise concerned?
No, you're absolutely right, Brad. One of the first things I did when I became CEO a couple months ago was announce and fill a new position called the Chief AI Officer. And he and his team are fully dedicated to evaluating changes in AI, the models, the use cases, the vendors that are providing services, and how we can use at Raymond James that technology to better enable financial professionals to provide better and more efficient and effective service to their clients. And so right now our focus on AI is to provide data-driven insights to those financial professionals to increase our already high service levels. Just this quarter, we won #1 in J.D. Power for investor satisfaction of any firm that has advisors. And more importantly, we won #1 in the industry trust category as well. But AI can better support financial professionals in providing service to their clients. And then also, of course, security and infrastructure of the company. AI is so important in ensuring that we have a secure environment for all the client information that we maintain.
All right, just as long as it's still in tandem with humans, Paul. I don't want AI going sentient on my finances. Please promise me that in the future. Appreciate the time.
Thanks so much, Brad.
Certainly. A revision from one of Wall Street's biggest bulls. Deutsche Bank is cutting its year-end price target for the S&P 500, citing the economic risks of the trade war. For more on this call from Deutsche Bank, we've got Yahoo Finance's Josh Schaefer. Josh, what do we know?
Yeah, Brad, so this is now the 11th firm that we track out of the 17 that I have on our tracker that has cut their S&P 500 target basically in the last month amid Trump's trade war. So Deutsche Bank moving their target from a very bullish 7,000, it was one of the most bullish on the street headed into the year, to 6,150, which candidly is a pretty decent rally from where we are right now in the S&P 500. So what Pinky Chada is saying in this note, essentially, he highlights 9 different headwinds to earnings, which really stuck out to me. There are 9 different separate categories, including things like direct hits from China imports, China exports, lower oil prices, persistent uncertainty, but 9 different things bring their earnings per share for the S&P 500 down from 282 to 240. What sticks out to me among that is, again, I keep saying 9. There's a lot of variables here. And I think that speaks to sort of what the market struggle has been, right? Is how do I price these 9 different things? All of them could change tomorrow. What sort of happens? And then sort of to round this out, what brings us back to 6,150? President Trump finally relents, is essentially what Chada kept writing about. So he pointed to President Trump's approval rating. If you look at Trump's approval rating, it actually hasn't come down nearly as much as one might think. It has come down, but he's essentially arguing that it has a lot further to fall. So on this chart here that you're seeing on your screen, he probably argues that, so you're at a little bit, I think at 47 essentially is your white line for approval. He thinks it comes down to maybe the mid to low 40s. Maybe that's when Trump sort of capitulates and backs off.
Sorry to jump in here, but this morning there was a Reuters Ipsos poll showing a 37% approval rating as well. So we are starting to see that dynamic playing out.
And essentially he's saying that if that continues to move lower, then at some point Trump will kind of throw in the towel on some of the trade policy. Now, of course, the risk here being, is the toothpaste already out of the tube, as one of our guests recently said, right, with this uncertainty, and do you get just an overall economy that's already slowing, even if we do sort of roll back on some of these tariffs, and that is a key risk to that 6,150 price target.
Which it's interesting as well that he's acknowledging just pulling back on some of the announcements or pulling back on how fierce he has been about rolling out some of the tariff policy without clarity here. So it's not talking about getting a good deal or having some type of negotiation that nets out in exactly what was promised going into the announcement of these tariffs.
No, Brad, I mean, look, going back to the part of this report I'm talking about where he talks about specific headwinds to earnings per share, $9 headwind to earnings per share out of the 40 that they took off just simply from persistent uncertainty. So if you can remove that variable, you in theory get $9 back, right? If we want to look at it in a simplistic way that way. There's $10 in here that is just China exports, China imports because of the level of tariffs we have on them. Well, if you roll back those tariffs a lot and there isn't this intense of a China trade war and American companies are able to continue to do trade with China, there's $10 back on your earnings per share. So essentially, yes, if you start to roll some of these things back, you might be able to save some of the earnings growth that people are now seeing getting a lot worse.
It also really sticks out to me that several of the headwinds he notes are key positions of the administration, like keeping oil prices low, for example. Is that going to go away if that's something that the administration has continued to say they want?
Well, eventually that just hurts energy companies' profits, right? And that's sort of what he's looking at there.
Absolutely. Josh, thank you so much. Really appreciate it as always. Coming up on Morning Brief, we're going to count you down to the opening bell, plus American Airlines joining a growing list of companies pulling guidance amid the uncertainty uncertainty. We'll dig into those results and Chipotle battling for burrito sales in this slowing economy. We're going to bite into the restaurant's latest earnings print. That and more on Morning Brief.
Now time for some of today's trending tickers. Another busy day for earnings movers. Here we're watching Merck, Nokia, and Texas Instruments. First up, Merck lowering its full-year profit outlook. The drug maker expecting to lose $200 million to tariffs this year, mostly due to the trade war with China. That charge does not account for President Trump's planned levies on pharmaceuticals. Still, the company topped first quarter expectations. Most notably here, and of course, one of the keys to this company's performance has been Keytruda. Sales actually grew 4% to $7.2 billion there. So essentially half of their revenue there of the total worldwide sales, which were $15.5 billion for the company.
Yeah, really interesting to see across the board. Obviously, the cancer drug being a boon for them, but their patent expiring in 2028. So could that be a risk moving forward? In terms of analyst reaction here, you've got a couple of different reactions across the street. Cantor saying the Keytruda miss was a little bit disappointing here. You also have the likes of BMO Capital Markets saying that Merck's beating on the top and bottom line with relatively muted impacts to tariffs. Noted the $200 million hit due to existing tariffs is relatively modest in BMO's view, but interesting to see that we are continuing this trend of companies talking about the risks of tariff policy this morning. Next up, Nokia warning of an earnings hit in the second quarter due to tariffs and supply chain disruptions. This coming after the telecommunication equipment maker's first quarter profit came in below expectations, hit by a one-time charge in its mobile networks business. And you can see those shares down 6.5% this morning. Interesting to see the degree of that drop here when it comes to Nokia off the back of this earnings result here. Again, those ADRs really moving off the back of this news this morning, and this coming after obviously a slew of potential headwinds for this name amid the tariff uncertainty and concerns about demand as well.
Yeah, as you talk about that earnings hit, two main metrics kind of come to mind. Number one, the net sales, that was down 1% year over year. And then additionally, the gross margin, that was down 820 basis points. So about 8.2% is what that would roughly equate to here year over year. And that gross margin move lower that we've seen on a comparable basis. And then thinking about what the company is commenting on, and most notably kind of looking out into the future on saying that their first quarter financial performance saw a net sales decline of that 3% that I mentioned. But then additionally, looking forward, they mentioned that they are not immune to the rapidly evolving global trade landscape. However, based on early customer feedback, they believe their markets should prove to be relatively resilient. We'll see how that resiliency plays out for Nokia shares. And Texas Instruments issuing a better than expected forecast for the current quarter, boosted by demand for industrial and automotive components. The semiconductor manufacturer also topping first quarter expectations. Company leaders there say that there is high uncertainty due to tariffs, but they don't see near-term effect on revenue here. Taking a look at shares right now, holding on to gains of about 9%.
Yeah, what's interesting is what Bernstein notes, that there's concern that this is about a pull-forward dynamic. Is there more spend happening ahead of any potential impact of export controls that could certainly hit a name like this and have hit the stock, by the way? You're looking at shares down 18% here year to date. TD Cowen saying against a wall of worry on tariffs, they were still able to put out a beat and raise. The fundamentals are improving. Customer inventory is low, but all segments are up on a quarter-over-quarter basis, but still the backdrop remaining uncertain. That refrain going to be a familiar one by the end of this earnings cycle. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. When we come back, we're going to bring you the opening bell on Wall Street and get you the market action. Stick around. We're just about 30 seconds out from your opening bell on Wall Street, but let me run you through a couple of the headlines catching the eye of investors this morning. First off, a big one, Beth Hammack of the Federal Reserve saying that there could be a cut coming in June, that leading to some optimism that the Fed could be coming in to help stocks amid some of the volatility here. You also have the first back-to-back gains of over 1% on Wall Street since that November 6th election day. Will the relief rally continue? That, of course, the key question as you are now hearing that opening bell on Wall Street. You've got images live from the New York Stock Exchange and your NASDAQ on the screen right now. But let's get you the market action that we are seeing at that open this morning here. Just flipping the board over so that we can take a look at how markets are moving just barely above the flat line in the S&P 500. Again, the big question, is that rally going to be able to continue today, especially amid the headline I'm watching most this morning, China throwing cold water on the idea of any kind of trade deal with the United States, saying, you haven't called us, we're not going to call you. Where does that leave us? No negotiation at the moment. You've also got your tech-heavy NASDAQ taking on a little bit more of the positive momentum this morning. Going to be interesting to watch as we have both Alphabet and Intel reporting after the bell. You've got some of a lift across your Mag 7, Amazon, Meta, and Tesla withstanding at the current moment. Apple just above the flat line, despite a downgrade this morning that impacted that stock. Also, lastly, I want to mention a broader S&P 500 cut this morning over at Deutsche Bank. Binky over there cutting his S&P 500 target from 7,000 down to 6,150 this morning. Brad?
All right, it's now time for our strategy session. U.S. markets opening mixed after China says there are currently no trade talks with the U.S. going on right now. This comes after stocks notched back-to-back gains earlier this week. So how do you manage the evolving uncertainty within your portfolio? Joining us now on set, we've got Michael Reinking, Senior Market Strategist at the New York Stock Exchange. And this is a market that is very much dependent on how the administration and some of the counterparts that are negotiating are classifying their discussions. What's your read through?
Yeah, I mean, so as you pointed out, right, we're in a market that's evolving very quickly. It's coming kind of via social media, via the commentary coming from the kind of from the exchange, and we've seen a softening of tone over the last couple of weeks. Kind of from the administration, that's helped markets come off of their lows. And then kind of the little bit of pushback that we've gotten overnight, it's kind of caused a little bit of concern. I think the other thing that's been pretty important is that we've started into earnings season. And I would say, broadly speaking, those numbers are coming in better than feared, right? You're looking at Q1 numbers that have actually been pretty strong. And then even the commentary and the guidance, we've seen kind of some companies pulling guidance. Those are more kind of consumer-facing companies that are starting to pull their guidance. But I would say, like, broadly speaking, the commentary that's coming from management teams is a little bit more calming than I think markets had potentially expected.
I think that's really interesting because in looking at some of the stats this morning, about 90% of those companies are mentioning tariffs, and then you have over 40% mentioning a potential recession. What matters more right now in terms of direction for the market? The actual numbers, the earnings results, or what they're able to spin as a story about how they'll handle the economy?
Yeah, so the way we've actually kind of discussed a lot of this in some of our written commentary is kind of this delineation of BT and AT, before tariffs and after tariffs, right? And that applies to kind of economic data and clearly Q1 earnings season, right? Q1 earnings are really that fall into that BT bucket, right? And it's telling you that the environment, kind of heading, before Liberation Day was still, holding up pretty well. We had seen some slowing, but in general, things were on pretty solid footing. Right now, you're in this period of uncertainty. We might need to actually add kind of a third bucket, kind of the uncertainty bucket until we have a resolution. Mm-hmm. All right, and you're now kind of seeing companies start to lay out, the groundwork of how they're going to try to mitigate some of the costs that they're expecting, kind of from these tariffs. Right, so cost mitigation measures, moving of supply chains, kind of things of that nature. I think the key is if we don't see companies starting to kind of pull the lever of headcount reduction, right, then we can kind of muddle through, right? So that is like a real key point. I think there's still a little bit of reticence, kind of at the corporate level coming out of the pandemic to, cut headcount too quickly, especially, kind of amidst the uncertainty because they had such a hard time bringing people back into the workforce, right? So I think there's still that reticence, but if we start to see that turn, that would be kind of more concerning for the economy.
I was looking at an interesting stat from a friend of the show, Ryan Dietrich, who we all continue to kind of discuss some of these interesting stats with. And a couple days ago, he was talking about 89% of advancers, 89% of volume advancing on the NYSE happened twice over the past 9 trading days. This was as of April 22nd. But the first big day is a clue. The second day is the signal. Rare stuff and is always marked lows. Do you think the lows are in this market right now?
Yeah, I mean, it's really hard to kind of definitively say that. I think there's a possibility, kind of that we would retest, kind of the lows that we had seen, but that would, kind of come with a very sharp turn from the administration in terms of the tone that they're setting right now. I think in the very short term, I think the market's trying to, trying to do some repair, right, and kind of reset, and we're starting to carve out a little bit of a range, right. So I think we've actually potentially touched both the bottom of that range and the top of that range in the last couple of days, right. So on Monday, we traded to 5,100 in the S&P 500. That was the post-tariff, 90-day tariff reprieve low in the day following that. We tested that in kind of a low volume sell-off in the S&P 500 and then bounced, right? And then yesterday we traded right up to the highs post the 90-day reprieve, between 5,450 and 5,500, right? So I think we're kind of setting a bit of a range right here, right? So you can kind of watch, watch those levels, kind of for some short-term signals. If we were to break to the upside, because we're actually holding up pretty well this morning, right? Despite some of the commentary overnight, if you break to that upside, I think you kind of potentially set up for a retest of maybe that 200-day moving average, 5750. That also, kind of ties out to some of the measured moves there.
I'm interested, Michael, you sound more optimistic than I think I had anticipated this morning, and maybe that's because I'm a journalist and it's my job to be a little bit pessimistic and curious about what's happening. But what is it about what the technicals are telling you in reaction to every headline that makes you think there is that potential for a breakout, despite the fact that it's becoming more and more clear that a negotiation is not really on the table at the moment?
Right. So, I mean, right now, I think it's kind of, the clues that I'm taking are coming from kind of earnings, right? And I think, that earnings, kind of the earnings expectations had gotten pretty low. So I think, that's giving me a little bit more, kind of a little more confidence in how the market's kind of trading in the near term. I think, look, bigger picture, I think there is some downside risk to earnings estimates more broadly, right? I think, there is I think the market's still kind of around 270. You guys just pointed out that Binky, kind of laid out a low end, potentially 240 for the S&P 500, right? So there is still that downside risk, but there is the opportunity, right? This is a man-made, kind of issue. There is an opportunity, if we find an off-ramp here, but time is definitely of the essence.
Big if there, right?
Yes.
That's the key question. Michael, thank you so much. Always really appreciate your insights.
Thanks for having me.
Coming up, a growing number of airlines pulling guidance amid economic uncertainty. What the global trade war means for the travel industry. That's next on Morning Brief. American Airlines withdrawing its full-year outlook, joining a growing list of airlines pulling forecasts due to economic uncertainty. Still, the company reporting a narrower loss than expected in the first quarter, boosted by strength in international and premium travel. Joining us now, Stephen Trent, Citi's managing director. Stephen, always great to speak with you. If negotiations were to hit as early as tomorrow here, does American Airlines come out with new guidance, and how do you rate the decision to pull forward guidance at the moment?
Yes, good morning, and thank you for having me. I think if negotiations were to occur tomorrow, I'm not so sure it would be as simple as flipping a switch. I do think, though, that at least sometime forward, that the airline would be able to get back to offering some full-year guidance, because some of these bookings occur at a lag, of course. So maybe you would need at least a couple of weeks of evidence to see that booking trends are stabilizing.
Steve, I think you point out something really key in that it's going to take a lot to kind of turn or reroute the plane once it's in the sky, because you're thinking about kind of a few things here. Number one, it's the capacity side that pretty much every major airline has said, we're going to kind of pull back some of the acceleration of our own capacity growth. And also at the same time, that means that we're going to rely on natural attrition and perhaps not hire as aggressively for that capacity. Plus, on the aircraft side, they're all, it sounds like, not willing to take delivery of any aircrafts if that means that there's going to be a tariff that's also going to be slapped on it as well. So how many quarters could this be, in what these airlines are talking about right now, how many quarters could it have a lingering impact as well?
Yeah, great question. And look, I think the tariffs, the economic uncertainty that we're going through today, unfortunately, was certainly not anticipated a couple of months ago. American, Delta, and others have strongly telegraphed that they're not going to pay tariffs on these planes. So in terms of how long it lasts, it's really hard to tell, putting on sort of my top-down economics hat. What self-help can the airlines deliver over that period? One easy place of self-help is to manage capacity. And what you could see, for example, if the economic rebound is a little slower than expected, there's wiggle room to retire aircraft, there's wiggle room to reduce off-peak flying, attrition, hiring freezes, and this kind of thing. Looking at the space overall, I would still say the network carriers, because of premium cabin, international long haul, and co-branded credit card, look much better positioned than the discount airlines.
Yeah, and talk to me a little bit more about that international exposure, Stephen. To what extent are you concerned that that could come under pressure amid this economic uncertainty, which of course hasn't fully played out in today's earnings print?
Yeah, absolutely. And look, I think, it'd be disingenuous of me to say that the economic risk to international is zero. But if you look, for example, at the relatively sort of small group that can truly offer bona fide international long haul, you really just have 4 U.S. airlines that have wide bodies with very good premium cabin capability, as well as looking at what's happening in global aerospace supply chain today. Yes, you have a shortage of aircraft. Generally speaking, you really have a paucity of wide-body aircraft per capita. So there's very little of that equipment to go around. And there's sort of a relatively small percentage of consumers that can afford to do those trips, either sent by their corporations or traveling for leisure or visiting friends and relatives purposes. So, in contrast with domestic main cabin, international long haul from the U.S. airline perspective is a relatively protected piece of the pie.
Steve, I love to ask you which airline is best positioned to really navigate some of the uncertainty right now. Is there one that is operating more clearly and better through the range of headwinds that all of them are trying to kind of get their operations in order?
Yeah, great question. Look, so I would still fall back on the big three. And I know I'm copping out there, but I can find one. But we're constructive on them. I would say United, for example, by nature of its international exposure, has the most international exposure. Let's say Delta gets the nod for being generally thought of as the best run. I would say American deserves some credit for the adversity that they've been through with that heart-wrenching accident in DC, as well as the fact that they already did virtually all of their refleeting before the pandemic occurred, when aircraft were not so scarce or expensive as they are today. So the big three for different reasons.
Certainly. Stephen, great to see you. Thanks so much for taking the time here with us today.
Pleasure.
Be sure to tune in next hour. We'll be speaking in with Southwest Airlines CEO Bob Jordan about the company's earnings and the state of the travel industry. You do not want to miss that conversation. Shares of Pepsi trading lower this morning after the company's first quarter earnings came in below expectations and trimmed its outlook, citing tariffs and pressure on consumers. Joining us now to break down these results, we've got Nick Modi, RBC Capital Markets Managing Director, who has a price target of $163 a share and a rating of market perform on the stock. Great to have you here with us, Nick. So just take us into your analysis that you've got on PepsiCo right now.
Yeah, I mean, look, we were cautious coming into the quarter. We've been cautious on PepsiCo. Their North American beverage business has been under pressure for quite a number of years. They've been losing share pretty consistently with Coca-Cola, but their snack business was really performing quite well, and that really started to slow down going back to late last year and kind of rolling into this year. And that's really what's putting a lot of pressure on their margins and their earnings. It's hard to see at this point, just given all the consumer uncertainty, that that's going to turn anytime soon. I think it's going to take some time. And remember, they took a lot of pricing, and they also took some chips out of the bag. And I think consumers are noticing. And so consumers are making different choices. We're seeing private label across the snack category actually have a lot more traction than what we'd normally see, even during recessionary or economic kind of constrained environments. So I think there's some wood to chop here, and that's partly why the numbers had to come down.
And given what you're laying out in that kind of backdrop for Pepsi, I know that they're essentially expecting no growth over the course of this year in terms of their latest guidance. Could it potentially go in the other direction? Could you see a decline over the course of this year? You could.
It really does depend. I mean, I think we can all agree that visibility is not very high right now for anyone. Mm-hmm. And so I think if the consumer does get worse, which, by the way, we believe that will be the case, that could definitely drive some downside. And also we have some other geopolitical actions or policy changes that puts even more pressure on their cost structure, like food ingredients, as an example. That could be another driver that could weigh on their results overall.
Do you think a worsening consumer environment is already priced into the shares right now?
Yeah, I mean, we've been quite cautious, and remember, Pepsi has really been under a lot of pressure on a relative basis. So I think many investors have also been kind of bracing for the outcome that we had today. So it feels like a lot is priced in, but again, given the lack of clarity and lack of visibility, and given the fact that they're losing share in their biggest, most profitable business, we need to get comfort that we're going to hit a stabilization point or an inflection point at some point, and it doesn't seem like that's really in the near term right now.
And Nick, I think it's important to note, and I imagine you'd agree with this, that it's not just the tariff and economic uncertainty. Another headwind among many is the GLP-1 usage uptick and the impact that has on things like snacking and soft drinks. To what extent do you think that there are other headwinds for this company that can't be addressed by a tariff negotiation?
Yeah, I think the GLP-1 is fair. I mean, we believe what's going on with PepsiCo is much more cyclical or economic related than GLP-1. We've done a lot of work in this area. I know that might be a contrarian viewpoint, but that's kind of what our analysis would point to. Then we have potential implications of not being able to use SNAP, or formerly known as food stamps, to buy carbonated soft drinks. So that could potentially be an issue. There's a lot of states that are coming up with state level regulations that are calling for that. So there's you have the food ingredient dynamic and what's going on with RFK Jr. In terms of taking out food dyes and potentially other changes down the road. So, there's a lot of wood to chop. And earlier this week, we put out a report basically urging and encouraging all of our companies to cut their earnings forecast significantly, because I think they need that flex on their earnings income statement to invest to deal with a lot of these changes, but also provide benchmarks and targets that investors can have high conviction in. That's the beauty of the consumer staples industry, is that when things are tough, investors really like to buy these stocks, but we're just not seeing it happen to that degree this cycle because there's so much earnings risk.
And Nick, if things are tough for consumers, what we've typically seen in the past is that they will flock to where they can get the best discounts and deals, and typically that has meant buying in bulk, and we see surges in places like Costco or Walmart Sam's Club or BJ's Wholesale. Are those bulk buyers enough in the interim period to at least buoy or save to some extent Pepsi and their competitors' financial performance?
Yeah, I don't think it's enough. And here's really the way you have to think about it. Buying in bulk is value shopping for higher income consumers, right? Because they're able to actually outlay the capital and they get a lower price per ounce. But if you're a lower or middle income consumer, you may not have all that capital to buy in bulk. And you might not even have the space because you're living probably in a smaller living area, right? And so I think really what's happening right now is that this is a middle, lower income issue that is starting to have some impact on higher income consumers because the stock market is under pressure. And so the combination of the two is obviously, why we've been so cautious and think things will get worse before they get better.
Nick, really great having you. Hope you'll come back soon. Thank you so much.
You bet. Thank you.
Next up, we're taking a deeper dive into Chipotle's most recent quarter. That's next on Morning Brief.
Chipotle reported its first same-store sales decline in 2020 since 2020, while transactions decreased 2.3%, the largest drop since 2022. The CEO joined Yahoo Finance to break down the key drivers of this decline.
As we look at our consumer visitation study, and we talk to consumers broadly about what is causing them to be on the sideline in this economy, it's really trying to save money, uncertainty around what's going on with the global economy. We are not going to take price in this environment, given where the consumer is, until we understand what's actually happening with tariffs.
Chipotle shares are turning positive after initially dropping 4% after the report. Joining us now with the analyst reaction to Chipotle's earnings, our very own Brooke DePalma, who we should add had the conversation with the CEO. Brooke.
Yeah, certainly lots of optimism coming out from Wall Street this morning. Many reiterating their buy ratings on shares. If you take a closer look at the ratings on the street, there are currently 27 buy ratings, 9 holds, and 0 sells on the street right now. Many, once again, reiterating in their notes to clients this morning. Now, some key drivers that we're watching, some key takeaways based upon the notes that we're hearing this morning. First, many expect Chipotle to be a show me story before inflecting. That was from Danilo at Bernstein. He wrote that he expects Chipotle to trade at a discount to its historical valuation until we see these initiatives as well as this macro environment rebound. He expects mid-single digit same-store sales growth, likely even in the second quarter. But he expects lots of debate about whether Chipotle's same-store sales growth will just be structurally lower or if its long-term fundamentals will support re-acceleration. Now, TD Cowen out with a note saying that Chipotle's softness is not necessarily brand related, but it's macro related. He said that the value perception, which CEO Scott Boatwright told Yahoo Finance, is still that $10 burrito on a national level. He said that that's really outperforming those fast casual peers by a similar magnitude over the last 6 months. And those new sale drivers, those are really key for Wall Street here. They are looking at that marketing acceleration that Scott Boatwright mentioned, not only to us, but also in the call, as well as these limited time offerings. We know that Chipotle is ticking up its marketing spend to nearly 3% of sales in 2025. That's up from 2.5%, and investing in things like streaming, social, as well as loyalty offerings, especially during the slow points of the summer, as well as a new LTO offering. They're ramping up to 3 new dips, new sides we can expect, as well as a protein offering this fall. Typically they do about 2. Now they're ramping up to 3, and those tend to do really well for the business.
Brooke, we're a minute to end of show here, but I want to ask you a little bit of a curveball. Walmart, Target, and Home Depot CEOs meeting with the White House. To what extent are you hearing from sources that there is an interest in the White House capitulating to some of these retailers? Just what have you heard generally?
Yeah, generally what we've heard when it comes to retailers meeting and really doubling down with tariffs is that these are going to impact these retailers the most. Walmart, for example, albeit lower, they still do ship from China. We know that Lowe's and Home Depot, they're going to be impacted by lumber getting imported from Canada. We want those homes to be more built. We want people to invest in investing to buy this, to redo their homes. We know that Lowe's and Home Depot has been struggling with that. So certainly this is top of mind, and it'll be interesting to see how these conversations turn out. Yeah. But largely, we're still seeing the 10% at least still in place.
Absolutely. Brooke, thank you so much. Appreciate it. That's going to do it for the morning brief. Stick around for Catalyst in the next hour.